Welcome to The Explainer. Today, we're going to dive into a financial tool that lets you trade the world's markets with some seriously high stakes and high leverage. And get this, often without paying capital gains tax. So let's break down spread betting. So let me just ask you this. What if you could profit from a company's stock soaring, or hey, even crashing, without ever owning a single share? That is the wild idea we are exploring today. Speculating on a market's direction, pure and simple. Okay, so what in the world is spread betting and how does it actually work? Let's get into it. When you boil it all down, spread betting is just pure speculation. You're not an investor, you're not buying a little piece of a company for the long haul. No, you are simply placing a wager, a bet, on which way you believe a price is going to move next. And here is the appeal in a nutshell. First, you don't actually own anything. Second, you can use leverage, which means you can control a huge position with just a small deposit. Third, you can make money whether the market is going up or down. And fourth, in some places, those profits can be tax-free, but you absolutely have to check your local laws on that one. Okay, theory is one thing, right? But it doesn't really click until you see the numbers. So let's walk through a real example to see how a simple bet can turn into actual profit or loss. A provider is always going to give you two prices. There's a buy price if you think the market's going to rise, and a sell price if you think it's going to fall. You see that 3-point difference between 200 and 203? That's what they call the spread. And, that's how the provider makes their money. So let's say you've done your research and you think this stock is totally overvalued. You think it's about to drop. So you place a sell bet at that 200-pound price. Then you decide your stake. How much are you willing to risk for every single point of movement? Let's say we go with 20 pounds per point. And boom, your prediction was spot on. The price falls 12 points, all the way down to 188. So you just multiply those 12 points by your 20-pound stake, and there you have it, a 240-pound profit. Simple as that. But, and this is a huge but, here is the other side of that coin. What if you're wrong? What if the stock price actually rises 15 points against you, up to 215? Well, your losses are calculated just as fast. That's 15 points times your 20-pound stake, and that means a 300-pound loss. Now this right here, this is probably the single most important thing you need to understand about spread betting, because you're using leverage. A pretty small market move against you can totally wipe out your entire deposit and then leave you owing even more money. That is a very, very real risk. Okay, so we've seen how it works under the hood. Now let's kind of zoom out a bit and really weigh the fundamental pros and cons here. Leverage is the engine. It's what makes all this happen. It lets you control a huge position with a tiny deposit, which can amplify your gains like crazy. But it is a double-edged sword, and it will amplify your losses just as powerfully. This can lead to something called a margin call. That's that dreaded demand from your provider to put more money in your account immediately to cover your losses, or they'll just close your position for you right then and there. So why would anybody take that risk? Well, for a lot of traders, it's all about flexibility. It is just as easy to bet on a market falling, which they call going short, as it is to bet on it rising. The costs are also super transparent. There are no commissions, just that built-in spread we talked about earlier. But on the flip side, the dangers are always there. I mean, beyond those margin calls, you have to watch out for market volatility. During a big news announcement, those spreads can suddenly get much wider, which means your cost to get in or out of a bet goes up instantly. It is, by its very nature, a high-risk game. So, how do you manage that risk? Well, there are tools. A standard stop loss will automatically close your bet for you if it hits a certain loss level. And for a little extra protection, you can actually pay a premium for a guaranteed stop loss, which closes you out at your exact chosen price, no matter how fast the market might gap down. This all brings us to a really fundamental debate. Is this a sophisticated financial tool for savvy traders, or is it just gambling with a fancy name? You'll often hear it compared to something called contracts for difference, or CFDs. And yeah, they're similar. You never own the asset in either one, but they do differ in things like cost structure and expiration dates. And crucially, their tax treatment can be completely different, which is often the big reason a trader chooses one over the other. So what's the official word? What is its identity? Well, in the eyes of regulators in major markets like the UK, the fact that you don't own the underlying asset is the key.
They classify it officially as a form of gambling. And that legal distinction is exactly what leads to those potential tax advantages over traditional investing.
And this is so important to know. This is not a global product. While it's pretty common in places like the UK, it is not available to residents in the United States because of specific financial regulations. The bottom line is, you have to check the laws where you live. So after breaking down all the mechanics, the risks, and the potential rewards, what's the one thing you really need to remember here? At the end of the day, spread betting is a tool of incredible flexibility. It lets you speculate on markets in ways that traditional investing just can't. But you always have to remember, that power comes from leverage, and that is an engine that can just as easily drive catastrophic losses as it can impressive gains. And that really is the final question you have to ask yourself. Understanding how it works is one thing, but deciding if that unique mix of total flexibility and serious risk fits your own personal strategy, well, that's another question entirely.